So good morning and welcome to everybody. Good evening, good afternoon, good night, depending on which part of the world you're in. My name is Lyndon. I'm the head of Marketplace at Wealth Migrate, and it's great to have all our channel partners and affiliates with us today. Today we're very excited to be giving you an opportunity to really get to know one of our sponsors, Allbest Investments. Really a much better perspective of who they are, how they choose their deals, what is their investment strategy. That is the key purpose for today. I'd really like to firstly welcome Michiel Lucas from Allbest. Michiel, great to have you on board. Thank you for joining us today.
Thank you. Thank you for having us.
And then also from Allbest today, we have Justin Clark. Justin, your web camera hasn't been shared yet, and I know we all want to be able to actually see your face. So if you could just share your web camera with us, that would be great.
And there I am. I'm being exterminated today. Morning, Justin, good day, everybody.
Welcome and thank you as well for joining us today. So we're going to dive straight into this and really, Justin, I believe, really have a chat to you up front about who is Allbest, what is it that your investment strategy does, who is your investment due diligence team, and how do you select your deals, just to really give our affiliates and channel partners an understanding of you as a company. So I'm going to hand straight over to you, and as just for all our attendees, please do feel free to pop questions in. We will be monitoring them, and I'll make sure that we're asking that of Allbest on your behalf. So thanks, Justin, over to you.
Thanks, Lyndon. I think it's our first official webinar together with Wealth Migrate, even though we've had a long association. So, you know, that's quite an exciting occasion and hopefully the first of many in the future. I'm hoping we've got a whole bunch of new people online today. So those of you who haven't been introduced to us before, we welcome you. To talk a little bit first about Allbest, guys, and this might come as a surprise. We say we don't actually invest in buildings. We invest in future income streams. And I think this is something that we have learned. It's all very well getting into an investment, and many of you who have invested in property will understand what I'm saying. And I'll use the example. If you invest in a retail property today, it might show you fantastic yields, but how do you get out at the end of the period? So when we say we look at future income streams, we look at the ability to exit at the end of the period. And that is really why we have chosen, and I think Michiel will give you a little bit of detail, how we actually funnel down the investment to get to the type of investment that we focus on. And our hyper focus, guys, is on medical real estate in the USA for these reasons. So the idea, and I'm not going to get into too much detail about medical, but many of you would have heard from Henny in the past that there is this amazing change that's happening as a result of technology to the way that medical services are being delivered. And it is creating this, if I can say, exponential growth in the demand for medical office buildings. In other words, outside of the hospitals, outside of hospital complexes, these independent medical office buildings that will house the services that are provided in the future. So what that means is that if you get into a property investment, it's all very well to look at the cash-on-cash returns, which are very important to many of our investors. But what's more important is the ability to exit at the end and make a capital growth. Bear in mind, our proposition to you as an investor is not only do we give you a very regular cash-on-cash return, but we also give you a balloon at the end, which we call a carry, which is effectively your capital growth, your share in the capital growth of the building. So I'd like to talk also a little bit about how we ensure that we look after your money. And you know, it's very easy to make an offering on a platform, but what we have realized is that ultimately we are responsible for making decisions on your behalf and looking after your money. So you know, the idea of an investment committee is all very well, but how does the investment committee actually work? So just to give you a little insight, what Michiel and his team will do is he will go around the world and look at many, many opportunities. And I must say, in the past, it was very much a case of taking the opportunity that we could get and effectively bring it to the company, and then it would happen. I think that what's happened is that we've made that investment committee completely independent. And that means that we have no power over the investment committee. The investment committee looks at every single deal that we bring to them and investigates, interrogates it, and then gives it the green light or not. And to pump up the investment committee, we have managed to convince one of the leading risk experts and property doyens in South Africa, a guy by the name of David van Drach, who has come from the head of one of the biggest banks here, where he founded two of the biggest REITs in this country. And I know that many of you are not from South Africa, but understand that you know, the likes of the assets under management of RMB are quite considerable, even in dollar terms. So we welcome David van Drach. And I just want to mention one more thing before we get into Michiel, that sometimes it's very hard for the company to swallow what the investment committee actually decide on. And you'll remember Med 13, which we launched on the platform not so long ago, and we were busy in the middle of funding it. The investment committee went into the building in the USA, came out, and took the very, very tough call to actually withdraw that investment at great cost to the company. So that is what the independent investment committee is all about, ladies and gentlemen. I'd also like to just talk about something new that we've had to introduce, which is
Justin, can I just stop you there? Because I think, you know, the exciting thing about what Allbest does is with this independent investment committee is, in a way, you are providing the investors almost a third party verification of the proposals that are coming out of your investment team. And that, as you said, that independence is important. Just in terms of that investment committee, I know you've mentioned the one member. The other members on that committee, how many people are on your committee there? Are they all South African? Is there different perspectives that get brought into that committee?
Yes, we're looking for we've got one more non-executive position, and we're looking for a US a person that's based in the US to fill that role. But the other non-executive person is Alan Bandrach, Alan Kainoff, who's been around for a long time, and is actually a significant investor in a couple of the projects as well. But I think he is equally independent because of that.
And just so for clarity, once again, because I think, you know, having spoken to a lot of our channel partners, they often ask us how are deals selected for the platform, and we say, well, you know, we bring the deals that the sponsors have done the due diligence on and that have gone through their independent investment committee. So this is a very key part of what the channel partners and our affiliates are really trying to understand. So in terms of any potential conflicts of interest that might be involved in that, is there a process that you keep? So for example, is there any disclosure at a per deal level that if someone is involved in deals, can these independent committee members be part of the deal structure or companies that are associated, or is there fairly strict rules there on the independence?
I don't think there's any rule that would not allow them to invest in a particular project. In fact, I think that we would encourage them to invest in a particular project. Even more important, because they're going to make the right decision, or they're not.
Yeah, no, not so much from the investment perspective, but I just want to, because it's a question we get asked. The property itself and the partners you are bringing to the table, they are not part of your investment.
No, absolutely not.
Okay.
Lyndon, I can just add some here. We have had in the past the instant where investment committee member invested in the deal, and he simply then excused himself for the actual decision of the investment committee. So if there's a conflict of interest, he doesn't partake in the vote. Most of the times that is not the case, because we have specifically developed relationships with our local partners in the US, and that's also one of the key things that we do, is that we bring their expertise in as a niche player in their specific market also to the table. So during the committee meeting, the property partner on the ground, which is actually having these 15 to 20 years experience, actually then give us also the local input. And then further, Allbest has also employed the service of a veteran acquisition manager in Atlanta, which then also give a US perspective into the investment committee. And then from there on, they then decide on the deals. Just a quick one on the criteria. I think we've been very vocal on the fact that we look for population growth in the US. And for those that have a bit of insight into the US, we've seen that there's effectively 4 places that's really the GDP driver of the United States, which is the New York State area, the West Coast, the greater state of Texas, and then the southeast corner of the United States. So we've currently have projects in both the Texas and the southeast of that, and we're also expanding into the New York State area. And the reason for that is we found growth opportunities very specifically, and then also very specifically to ensure that our rights as property owners are embedded in our lease terms. So if you remember, Justin started off with saying we are investing into income streams. That income streams are driven by the lease terms, and that lease terms must ensure that should there be a problem with the tenant, that we are able to legally can easily take them out, which we found is the case in most of the times.
Great, thanks, Michiel. So the clarity I heard which is very encouraging, and I think for all our channel partners is the really exciting part of the All Best model, is that they do have this independent investment committee. Those committee members are not part of the actual on-the-ground property companies that they're partnering with. So there's no conflict of interest there. And certainly, Justin, I agree with you. Now, I'm an investor. I like to know that the people making decisions are investing alongside with me. That means that they too have faith and believe in the deals. So, I think if the investment committees themselves in their personal capacities are putting their money where their mouth is in the deals that they're supporting, I certainly think that's a good sign. And so back to you. Sorry for that. The reason we emphasize the investment committee so much is that from our feedback, this is such a key component of our affiliate and our channel partners wanting to understand in terms of your guys' processes. So thanks for allowing us these extra few minutes to really delve into it.
Excellent. Aware of time, so I'll cut short. Basically, Michiel is no newcomer to most of you on the call today, but I think that in my experience of sitting next to him and one of the things that is very interesting is that Lyndon, we effectively are, and people ask us, why is it that small investors invest with us? Because the returns are so good. Is it not that family offices and institutions should invest? And in fact, that's where a lot of our interest is coming from at the moment. The big guys are starting to say, well, hold on a second, if you can do that on a repeated basis, we want a piece of that. But I'm going to circle back to Michiel. So it's very interesting sitting in a meeting and watching one of these, or a panel of these experts or risk experts trying to interrogate Michiel and interrogate our structures and our systems. And it's like ping pong, he gives it back again, and it's he's an enormous asset to this company and to this team. And so we're very glad to have him on the call this morning. So I think without me rambling on, let's get over to Michiel and hear about the real stuff. Thanks, Lyndon.
Sure, great. Thank you, Justin. Michiel.
Thank you, Justin. Thank you, Lyndon. Today, I would like to introduce our current opportunity, which we simply call Glenridge Medical 22, and you'll pretty quickly see why. The opportunity is a fairly large 2 buildings, which in square feet is 185 for those that's still in metric. That's simply divided by 10, so that's roughly 18,500 square meters. So it's in Atlanta, Georgia, and the building opportunity that we are going to investigate here or display today is really an opportunity where we are going to reposition this opportunity from a fairly dominant office environment to a medical environment, and that's really where the opportunity lies and the value is created. You'll see the building is a fairly big size building, and the amount of equity that we're raising is 5 million equity. So the property is extremely well located. We're going to go through that in a lot of details. Very, very significant tenants, and we've got a partner which has got a significant track record. But let's go a little bit into the detail, and I'm going to repeat a lot of details if you have heard Obvious talk before, but for those that are new to Atlanta and Georgia, I'm just going to give a bit of a detailed overview of that state. And the reason why we kind of like that state is specifically the landlord friendly, which I alluded to earlier. There's a very interesting peculiarity in this state, which is called the Certificate of Need. And that basically means that if a doctor has got a facility, maybe an MRI machine or some fairly expensive equipment, this equipment, also a surgery center, are registered against the need in a specific area. Why that is significant for us as landlords is that the competition of that doctor cannot invade his territory unless he can prove there is additional need for this specific service. And hence it actually protects the doctor, which is in real terms our tenant, and therefore they protect this space or this location, and from that we also get longer term leases. So that's a very important thing for us. It's not in all the states, but it's specifically in Georgia. And the nice thing about it, it's registered against the specific address of the property. So it means if the doctor leaves, he doesn't leave with the doctor. So that's very significant. Georgia has absolutely pro-business. A lot of the big companies, specifically the Fortune 500 companies, are relocating in specifically Atlanta. For those that don't know, Atlanta airport is now the busiest in the world. Simply because of the location, it's so convenient for international companies to really address the international market. So there's quite a lot of additional facts that I mentioned here on the slide, but I think the key thing for us is that this state keeps on popping up in the population growth. So it is pretty much one of the fastest growing population growth that we've seen for a very long time. We've been part of this investing in the city since 2014. And over the last 5 years, we have seen this continuous growth. And every time we get there, it just amazes us how the state actually grows. So from that perspective, very, very buoyant state from a business perspective. And then specifically Atlanta, the Atlanta metropole is really large. If you simply drive from north to south, east to west, it typically takes on average roughly about 2 to 2.5 hours. Most of the time, if we visit our portfolio, we have to actually spend most likely full 2 days or now even a third day just to get to all the property. Like I mentioned, the Hartsfield-Jackson Airport is a gateway city. It's pretty much huge passenger flow and extremely convenient for a lot of Americans. Then from a business perspective, I've seen firsthand how the state actually lures large clients, notably Mercedes-Benz and Hyundai has actually relocated their North America headquarters down here south, if you can see my cursor, near Marrow, and that is really, we're also very near to the airport. And then I think the key for us today is we're going to discuss the property, which is located in the, let's call it the suburb called Sandy Springs, or county as I call it. And this is on the proverbial ring road. This ring road is the 285. That's pretty much right around Atlanta, with the Atlanta's city center in the middle here. For those that know, Atlanta has actually got like 2 city centers, the mid-city, and then the area a little bit north here, which is Buckhead, which then flows into Sandy Spring, which is effectively the epicenter of the medical growth in Atlanta. So it's also the place where it's the highest concentration of medical office blocks, and I'll go into detail quite a lot. What we have seen in the past is that the 75 highway, this one going here to Chattanooga, and this one going to Raleigh in North Carolina, is proverbial creating a triangle, if you can see it. And this triangle, led by the other highway, which is like a super busy highway, is called the Georgia 400. So this is the growth corridor, and we've seen quite a lot of development on this growth corridor. And Obvious specifically are partnering with a partner that has been operating in this area for 4 decades. It's not often that we find a partner with that wealth of experience, and they have got numerous sites on the Georgia 400 where we have also, as Obvest investors, have invested in the recent past. So from that perspective, we're super excited about the location, and I'm going to go a little bit into the detail of this location.
Michiel, can I just stop you there? Michiel, we've had a question come through. The question is, can you please explain the relationship between yourselves and the partners on the ground? So I'm assuming that just trying to understand that relationship between the partners. What are the roles do you guys as Allbest play? What are the roles the partners on the ground play? And how does that work?
Okay, I can go through that. Let me just complete this story on the location, and then I'll jump into the partners. So sure. Just want to make sure that I just finish off the story. As I mentioned, here's the 285, and as you can see, the Georgia 400. And this area is, in the local language, it's called Pill Hill. It's as simple as taking pills. As you can see, the Northside Hospital is here, St. Joseph and children. Most of the babies in the state of Georgia is born here, and our property partner in this specific case was Richmond Honan, and they have developed over 1 million square feet of real estate in this area, and it is just a very natural progression to simply go across to the other corner where the subject property is. And before I go into the subject property, Lyndon, let me explain how we do and work with our US partners. So what we are set out to do is we are looking for partners that is absolute specialist in the medical real estate field, which is the focus of Allbest from a segment perspective in the market. The property partners typically have a minimum of 15 years of experience in that specific area. They are niche players, and they normally have a pipeline of deals. What they are doing, they're typically either managing a lot of properties or are developers, and like always, they are in the need of equity and also setting up partnerships with investors. And this is what Obvest's role is, really setting up the partnerships and then actually managing the portfolio of properties with the partner. We are joint manager, and we have also full step-in rights in a situation if the property partner for some reason do not perform. One of the key aspects of our property partners is that they have the ability to stand surety for the loans that we require to buy these properties. As you can think, if you have a multiple of investors contributing to the equity component of the project, it's not an easy task for them to actually stand surety in the United States for fairly large commercial loans. So this is one of the key aspects the property partners actually bring to the table, is the fact that they typically stand surety for what we call non-recourse loans with bad boy carve-out clauses. So the bank requires American that's got a substantial balance sheet to actually still oversees the bad boy clauses, even though it is a non-recourse loan. And then the last aspect that the property partner does, they normally have an extreme good network to lease up these buildings, and that's part of the value add strategy to actually change tenants and add them. So these are the three main components, Lyndon, that our property partner brings to the table. So I hope I answered the question. Let me know if that investor is happy with the answer. So
yeah, no, that's great. Thanks, Michiel.
Going a little bit deeper into the actual property, as I alluded to, this is just a different angle. These two buildings, we call them building 100 and 200, is actually the subject of the property. As you can see in the specific slide, it is directly across Pill Hill, and there's a very nice access road across the Georgia 400. and that is the reason why we really love this area. From an Orbwest perspective, just underneath the highway, these are the 285. We have got our Medical 9 investment over here, so we're pretty familiar with the area. And just some additional information is that this whole area has been rezoned for a 12-story development, and the actual parking lot of this buildings is going to get a full-blown additional medical campus. So it really is going to also get a higher concentration of medical office block in this area, similar to across the road. And the reason why that is relevant is that this bodes extremely well for the value of these properties, because it will naturally be lifted up with additional value that's being created. This area is so intense from a let's call it land location. The land has skyrocketed, and the need to actually concentrate in terms of buildings, etc., is extremely high because of the huge demand that's coming here. So from a location perspective, I must be honest, Lyndon, this is pretty much from a location, most likely the building that is the best located in our portfolio so far. So we're very happy with that. And lastly, obviously, a lot of the services that's in our building also then service the hospitals nearby. And one of the key criteria that we're looking for is on or near a hospital campus. The reason for that is there is a huge trend in the USA which basically says that doctors that are normally forming part of the huge hospital systems want to now leave the hospital system and go outpatient route, which means it's out-contracted, and then they can actually set up their own practice with their own administrative systems, which is more, in a certain way, lucrative to the doctor and also less restrictive. So that is a big trend, and so having buildings right across this huge medical hospital center bodes well for doctors that would like really to have their own practice out of sight of the hospital system. So I think that is another major trend that we are seeing in the US at the moment. So diving a little bit deeper into the property, this is really the value play that we've got. A large portion of the building is not medical, and our strategy is that some of the other tenants you'll see has got shorter leases. We are going to transform them into medical. Why we like the eVest, as you can see, it is a pretty strong lease till 2029. And from an investor perspective, if we have an investment horizon of 5 years, this bodes extremely well for when we want to sell to a new buyer. And the buyer, as we call it, will still have some meat on the bone. That means that the lease has still got some value because it's still longer, at least another 5 years. So the key focus for us is Northside Hospital, which is going to renew its lease. We're already in negotiation, and that's part of what you see here. So if we manage to do that and change these smaller deals into medical tenants, then we would really significantly add value to the building. Why is that possible? Is that in this specific area, like I mentioned, there's such a need for medical practitioners that would like to set up practices, and we believe that this will happen. From an investment strategy perspective, as Orbwest and our partner, we have already made provision that when there is a gap between the existing tenants and the new tenants, if we do what we call a rollover, those rent we have raised as part of the initial capital, so that we have it in the kitty, so that transition should be very smooth. So also our partner, Richmond Honan, his father has actually founded Northside Hospital, and as a natural, I think there's an extreme strong relationship with Northside Hospital, and the indication is that this major lease of 30% will be extended. So all in all, a very solid strategy to add value, and the way that we add value is that you'll see when we change the office tenants to the medical tenants, we have a possibility to add a premium to the actual rent, and for that premium they ask us normally to build in some of the equipment that we actually then finance through them. We call that tenant installation, and that just bodes well that the doctor would like to really stay there for a longer period. Like always, investments have risk, and we've tried to...
Michiel, can I just stop you there? We have a question here. It says, please confirm the value add here is in the change to the tenant base, not additional physical construction or renovations.
Yes, the actual change in tenant base, maybe to explain to the investor, is that a change in tenant base also requires that the new tenant sometimes would like to have a different layout on the floor or install additional equipment. So there would be what we call tenant installation, which is construction. So that would be the construction. And then, as I alluded to, the overall area of the building, around the building, there will be construction, and that construction is earmarked to be done in about 2 years' time, which bodes extremely well for the time in roughly 5 years' time when we would like to exit, that the surrounding area has already lifted up. So I can't exclude that impact. So sorry for the long answer on that question.
No, perfect. I guess a follow-up, are you predicting that there might be cash flow implications at that point when you're doing the additional buildings, or has your financial model fairly much got a steady return, projected steady return through the lifetime of this 5 years?
So we expect that there will actually be an increase in cash flow in year 4 and 5 because of the change in tenants, and that's also part of the value add strategy. The moment that we increase the net operating income of a property, that is directly in relation to the value of the building, and that also then ensures that we then have the capital gain that we expect in 5 years, because that's directly proportional to the higher lease rates that we get. And for the existing lease rates, we normally have escalation per year. So for those that know that from a commercial perspective, your value of your building is directly proportional to the income of the building. And then, of course, it is related to the environment around the building. So if the buildings around you are super valuable because of the high concentration medical office blocks, you can also enjoy that higher concentration because there's not a way that you can actually copy or expand or create competition in the same place. So from that perspective, the location bodes extremely well because of the scarcity of land. All right, so comfortable, Lyndon?
Yeah, great. So Brian, who asked that question, thanks. It certainly sounds like even though there are plans in year 3 or 4 maybe to do some additional construction, it won't impact the projected cash on cash returns during those times because it'll be offset by the additional revenue. Michiel, have I got that correct for Brian?
Yeah, no, thank you, Lyndon. I think you summarized it very well. From our perspective, we also like to deal with the interest rate risk to have it fixed. So that's a very specific focus for those that has been following the US from an interest rate perspective. You also have seen that they have actually not increased the Federal Reserve rates in the recent area, and we actually expect it to go down. So from our perspective, banking-wise, the American system has been extremely stable. The lenders are very strict at the moment, so we have nowhere near the crazy lending that was prevalent in 2008. So all in all, we are pretty happy with that. Then from our perspective, the other thing that we also looked at very carefully is from the senior loan perspective. We have a debt coverage ratio. What that basically means is how many times we can pay the loan payment out of the net operating income, and you'll see it's very specifically the senior loan is at that levels. So all in all, coming back to the overall, we expect the investment to have an average cash on cash expectation over the 5 years of 8.1. Remember, that is a projection, as best as we can forecast it. Then from a internal rate of return perspective, that is the 15%. Internal rate of return, for those investors that's not familiar with that, is the summation of the average income cash flow, the 8.1, and then over and above that, the capital gains that we expect. What is very significant about this opportunity is two things. First of all, the deal has already been bought. That means our property partner already owns the property, so there's no risk for this deal to fall flat from a perspective that we still have to buy it. And secondly, I encourage all investors that if they're interested in this deal to actually move their money as quick as possible. We are taking 500,000 tranches into the deal, and from the moment that tranche is in the deal, investors actually earn their returns. So it's not like a deal where you first have to buy the property and then only you return. So there's a very minimal gap between movement of your money and starting earning money. And then lastly, our property partner has got the view that they are a generational company. It means that they are looking at holding properties 20, 30 years. They have been doing this for the last 40 years. And they are very clearly would like to keep this building as a long-term asset. And that bodes well for the investors because it's then a planned exit. What the property partner does, it simply refinance out the investors as if it was a sale. And how we keep everybody straight and honest is we simply use professional third party to evaluate the value of the building at the time. And then we actually then give the investors a return based on that external evaluation. So that will be a third party, and that means that the property has got a very fixed plan exit. We don't have to source a buyer to buy it. We already know how it's going to happen. And from that perspective, I think just bodes extremely well for this investors. Like always, we are very conservative in our projection, and Lyndon, for those investors that has been with us, you'll see we always exceed our expectations. So hopefully this is the base case. I've got some good feeling that it's really going to be a little bit more than that, but like always, we're conservative and it's no way that we can say something for sure. But believe me, we have done our homework on this specific deal, and I believe that it's a very, very solid investment in a very solid place. Yeah, then like I said, the exit strategy, just to repeat it again.
Michiel, I've just got two questions that have come through, and I actually think the second one you might cover here, so I'll hold it. But the first one was, I'm assuming it's from Kieran. Kieran, I hope I pronounced your name right. But it says, what are the impacts of state or federal tax implications on the returns? So I'm assuming that on your previous slide you had a return and that was pre-tax. I think that the question is specifically around that.
Yeah, for those investors that invest through their local entities in the United States, the impact of the state and federal taxes will be in respect to your personal tax situation. That means that the property will deliver pre-tax returns to the investor, and then the US investor will then take care of the tax implication in their personal capacity. With regards to the offshore investors that use our offshore listed vehicle, the impact on that would be is that if there's a tax change, we as Obvest in the project pay the state and federal taxes in the investment structure. Once that has been paid, we repatriate the net proceeds to the offshore listed entity, which we currently have, and then investors get then their returns as dividends, both income and capital. So from that perspective, We've got a fairly efficient tax structure that we've been doing for the last 4 years, and the impact on that should be very minimal. A matter of fact, the United States has actually reduced the tax rates. For those that know, Mr. Trump has got the tax changes through that the corporate tax has dropped from well in the 30s now to about 21%, if I'm not mistaken. So at the moment, the trend in the United States is actually to pay lower tax and not to change tax. If Mr. Trump loses the election, then your guess is as good as mine.
Great, Michael. So if I heard you correctly, the structure in the US will pay the... Sorry, we're getting a lot of echo. I'm not sure if you're hearing it from your side, but let me just see if there's a... Let's try that again. So my understanding is the structure in the US pays the local US-based tax that is required before they distribute it to the offshore structures. In this case, Wealth Migrate will be an investor into that offshore structure. So we will get that through that, and then we will distribute through our systems. But the initial tax piece will be covered in the US. And that will vary. If my understanding of the tax situation, it will vary depending on how your structure is declaring that income, whether it's going to be dividends, capital gains, but you handle that. Have you got any sense on that impact from your previous projects or your current projects? And please, I know all our channel partners and affiliates, you understand that no one on this call is a tax expert, and we're certainly not giving tax advice at this point. Although, Kieran, I do understand your question is you're just trying to get an overall sense, maybe from past projects, as to what impact that tax at the US level might have in terms of those returns. Michiel, is it something you'd be willing to give a kind of an overall sense of?
Yeah, look, when you review our product brochure, you will see that we have specifically outlined the expected returns for a US investor and the expected returns for a foreign investor. Lyndon, this includes obviously through the Wealth Migrate structures, if they have that. I can only talk up to the Obvest structure level in the offshore side, and you will mark that the only real difference is not on the income level, but only on the capital gains level. So if typically there could be a little bit impact on the capital gains, but as far as we have seen in the last years, is that the tax environment should be fairly stable because of the situation in terms of the US politics, where the two decision-making bodies in their parliament are in different parties. So our expectation at the moment is we don't expect a tax change. So if there is a tax change, the implication normally is a little bit on the capital gains. The income side is pretty neutral.
All right, great. So Kieran and others, we have got all the information from Allbest for this deal, and inside there it will explain the estimated returns that you might receive differently as a offshore investor versus US. So we'll certainly make sure that we pass those on to you if you haven't already got them. Michiel, just the second question that had come through was from Claudia, and she was saying at the point when you are exiting, and you might cover it here, and you get that third party to do the value at exit, is it Allbest or the partner on the ground that chooses the third party?
Normally it's actually the banks. The banks is the guys that's actually going to lend the money, and normally they are fairly strict in the procedure and how it should be done. So normally that gets dictated to us and the property partner.
Great, thank you, Claudia, for that one. That's it from the questions for now. So Michiel, please keep going.
Yeah, now I think I'm pretty much through the investment. I think just to summarize is that we really believe this is in a superior location. I think the second thing is that the environment, like I outlined, really bodes well for this medical precinct, as we can call it. We still believe that the 8% dividends is exceptional for this stability of returns. So from that perspective, we've just been in lots of part of the world, so we're getting very, very positive feedback on that. And I think the reason for that, Lyndon, as both Wealth Migrate and Obvest, we really strive to do this at a minimum cost. And really, we and the investors only really make our money at the end of the project, where we share in the capital gain. And that just makes sure that all our interests are aligned with the investors' interest. And this recipe has been working for Obvest and Wealth Migrate for a very long time. And we now also in the first phase of actually having our first full cycle investment. We've been doing this now for 5 years, and we are in the process of selling our first major portfolio. And that's extremely exciting for us, because now we can actually prove that we've made the investment fly, the investment returns has been better than projected, and then we are doing a full cycle deal. So that's what we're busy with. And then I think key for Obvest is this is a curated deal. The due diligence is virtually done, no exceptions. We're happy with the deal, and therefore we can definitely see very consistent dividend. And then number one focus for us is capital preservation, and therefore we're in a location that really makes sense from a stability, from a legal framework perspective, in the epicenter of growth in the southeast corner of the United States. So very appealing value proposition. Right. Thank you, Lyndon. That's it. I hope I get a lot of questions. It's always nice to really answer some questions and give some more insights if possible.
Yeah, great, Michiel. So no, there haven't been any. Let me just have a look here. Sorry, there might be a question here. That's just another one that's come through in addition to what's already been asked. Here's just Ian asking it for recording so they can send it out to their team leaders. So that's not a problem, Ian. We'll make sure we do that. Let me just get. There's another one here.
Lyndon, maybe for your information, I think we'll definitely supply it through to everybody. We also made a specific product video on this deal. So over and above the webinar, we also got a product video, and then we also got some very interesting footage of the deal. So we'll definitely make that all available to you and your investors.
Michiel and Lyndon, I've already circulated that via Lee. Just confirm that you have got it to your affiliates.
Absolutely. I think Lee has sent out a link to most of the affiliates already, but if not, we will be sending that out later today. There is another question here for you, Michiel. It's on the understanding that you raise equity from multiple different places, and Wealth Migrate is just one of your options. There's a question here about how many dollars has already been put down by investors. Are we still in the first 500,000 package?
We have surpassed that already. We have got commitments of roughly $1.5 to $2 million already. So it's going pretty quick because most investors now are not waiting for the deal closing, but they are moving the money as soon as possible. So we are already in the first package, will be a little bit larger because of the escrow requirements, more towards $1 million. And then once we pass the $1 million, then every $500,000 thereafter, we will then put down.
Great. And do you have the follow-up question? Do you have an expected timeline? Absolutely. So to follow up as well, we will certainly be supporting all our channel and affiliate partners with information and the process to help them get their clients into the deal. But do you have an expected timeline as to when this deal is likely to close, either from a time perspective or from your current projections, so that we can really work with them as they're approaching their clients?
Yeah, we normally see that these type of investments take roughly about 3 months to raise. We had a bit of a start in April where there was a lot of holidays, but we've definitely seen it moving faster now. So our time frame is pretty much, I think, I would suggest end of June, mid of July, I think this deal will be closed. There's a number of players that's starting to look at it. They're going through the due diligence, and once the partners or the affiliates has done their checks, normally they then also recommend it to their clients, and then things happen quite fast. So, so my suggestion is don't delay. This is really a significant opportunity, which doesn't come often. Yeah, so my suggestion is, I think you're going to have roughly about a month and a half, maybe 2 months left.
Michiel, I've got one more question here. It is, in terms of the investment strategy, this is listed on the Wealth Migrate platform as a core deal, though it sounds more like it is a core plus deal. Can you comment? So maybe I'm happy to take a stab at that. So thank you very much for that question. Yes, we are using the standard investment strategies on our platform. And just the difference between the two, as a general overview for everyone, core deals are very much A-class investments with A-class tenants, where the building is pretty much tenanted as best and as well as the real estate investment firm can expect, and it's a very safe, stable investment. Whereas a core plus, it's the same quality of building, same quality of position, but there is an opportunity through improving the tenant base or the length of the lease to get a bit of added capital growth value through that change in terms of, as Michiel explained earlier, the way the building is evaluated. So yes, I would certainly agree from what Michiel has said today, that this is certainly a core plus opportunity, and that there is some opportunities here for actual value growth through the changes that Michiel and the team are planning to make in terms of the actual changes to the tenants and the leasing structure. Michiel, would you agree with it or disagree with that summary?
No, I think Glennon perfectly. The whole idea that we as Opvest have set ourselves out to do is, the first principle is capital preservation, which is pretty much what I think we all understand as core. And then the second part of the strategy, we always like to add a little bit value to it, where we can get a little bit of a kicker or a little bit of growth on it. And that's where the plus comes from. So I support your assessment, Lennon.
Yeah, and I think just to add on that, as a follow-up question is, why would we not include this as maybe the opportunistic or the value add deal, is because those often do require some kind of change to the underlying either structure or strategy of the building. Whereas I don't think this pushes those boundaries too far. You've stepped very much in a more conservative approach. It's not like you're wanting to do major renovations or changes. It's just through the opportunity you've spotted in the tenant list. So so once again, we do not believe this goes into the value add or opportunistic space. We certainly agree with Michiel's comments that this is a core plus opportunity.
Yeah, normally if that is opportunistic space, then we typically have a building that could be, let's call it 60% or 70% tenanted, and then there's a significant empty space that we add to. That would be, in our world, a little bit more of a opportunistic space. But then again, we very specifically, like Justin has outlined in the beginning, are absolutely clear we would like to bring the consistent dividends. And normally, if you have such opportunity, then the initial year or two has got a low dividends, and that does not fit our strategy. So therefore, we do not focus on those opportunities at this time.
All right, great. Michiel and Justin, there are no more questions that have come through, and I see our time is pretty much up. We are perfectly on the hour. So I really want to thank both of you for your time today. As you know, when we do get any additional comments or queries from our channel partners, affiliates that we would like to connect you with them on, we will certainly keep that relationship. So to all of those of you who joined us and joined myself and Michiel and Justin today, thank you very much. If you do have any further questions or follow-up, or you need support in any way, please do reach out to myself and Lee, and we'll make sure to get you all the information you need. Guys, thank you very much. Appreciate your time today.
Thank you, Leonard. Thank you for hosting us.
Thank you for the opportunity.
Thanks, guys.